55% of stocks actually closed higher today, but the stocks that mattered fell, and that made all the difference. The tech sector got hit especially hard, and a key reason that technology stocks fell down so much is because Anthropic, an AI company, launched new software that automates some legal work. And fund managers are concerned that some of their positions can lose a lot of value because if the legal industry can be disrupted, then so can consulting, financial services, and a bunch of other things. There were multiple tickers and different companies that ended up crashing from this today. One of the more popular ones being IT or Gartner, which was down over 20%. S&P Global, SPGI, also fell down 10%. Intuit and Equifax were down, and Moody's and FactSet were also down quite a bit as well. So this is definitely ruffling some feathers, Mike, especially in the software industry. But fund managers are also now the least hedged that they've been in 8 years.
And that makes this more of a problem than it ordinarily would be. It looks like fund managers have gotten pretty greedy and complacent over the past few years as the stock market has just popped up so much. It seems like a lot of them no longer feel the need to hedge. So it makes them a lot more easy to get spooked by new developments just like this one. Plus, when you add in the new problems between the U.S. and Iran, it makes for a lot of selling pressure. Today, a U.S. fighter jet shot down an Iranian drone that aggressively approached a U.S. aircraft carrier, and then 2 gunboats from Iran approached a U.S.-flagged tanker in the Strait of Hormuz and threatened to board and seize the ship. This sent oil flying. This benefited a lot of oil stocks like ExxonMobil. I know that big money play is going crazy right now. And all of this is happening as the U.S. and Iranian officials are due to meet on Friday for diplomatic negotiations meant to avert a military clash, but now Iran wants to change the location of this meeting and who's invited to it, further complicating an already delicate situation.
Yeah, and we've seen oil have some great movement because of this Iran situation starting to develop initially. And, we can see over the past couple weeks, oil had exploded, but it did pull back as traders were a bit distracted with the government shutdown and other developments. But in recent days, especially today, with the U.S. warplane shooting down that drone, we really saw a big uptick in oil and those oil stocks. Shout out to that big money trader for the ZOM trade. That was a huge trade worth over $2.4 million, and it expires on April 17th of 2026, and they got the 135 strike calls. But Mike, whenever I think about the overall market and oil flying up lately and global tensions increasing, it has traders a bit worried that we could be overextended and that there could be a pullback coming into play. And something that we have here is if we actually look at the 30-year to the 2-year Treasury bond yield ratio, this is really good at calling certain peaks on the S&P 500. So what we can see here is that whenever we look at the 30 to 2-year bond ratio and we actually look at the RSI for this, whenever it crosses above 50, like it is right now, this has coincided with the COVID decline, with the great financial crisis in 2007, 2008, and even the dot-com bubble, and then even the Iraq and Kuwait situation from the early 90s. So there's 4 great examples there where this pretty much called the top, so to say, on the overall market.
Yeah, and of course, there have been some false signals like we saw in 2005, but this has been a pretty good indication of when the market tops out, and unfortunately, that's what we're seeing right now. Another thing worth keeping in mind is that we did have another Hindenburg omen trigger today. There was a Hindenburg omen trigger on Thursday as well. This is generally a bearish thing for the market. We could see, especially when you have a cluster of signals, it normally does indicate some weakness in the short term with negative average returns from as soon as 1 day later to as far out as 2 months later.
Yeah, some of these returns have been negative, and in the ultra short term, looking at this data specifically from 2025, if we look at October and November, we had a lot of negative readings there, especially going into the 1 week later to even 1 month later columns, with the market only going green 43% of the time 2 weeks later. So very interesting data there. I will keep my eyes on the overall market in that sense, Mike. But whenever we look at the SPY itself, it's actually 1.28% away from all-time highs, at least at today's close. But a lot of traders were pretty perplexed at the overall downside move that the SPY had today, closing down 0.8%, and it was a lot worse than that at the low of the day. If we zoom out on the SPY on an hourly chart, the SPY was actually really close to all-time highs just this morning. But something that we're watching for is as the SPY approached those highs, it also approached a massive resistance. And the last time that the SPY was really bouncing off of this resistance, we saw a big collapse out of the SPY itself. And the low that it posted on that collapse was right around 685. Well, guess where the low was today? Once again, we bounced off the same resistance, and then we bounced off pretty much the same support at that 684 to 685 zone. So I bet you could have guessed that zone is going to be the biggest level on watch for tomorrow. If that starts to break down, I think traders are going to get a lot more worried about a larger sell-off coming into play, and then ultimately possibly even that bigger recent low closer to 676 coming back into play too.
Very interesting. And when we look at the market in a shorter term sense, we are starting to form lower highs and lower lows. We can see the lower highs are from 698 down to like 697.50, and we're starting to see lower lows from, you could say, like 685.20 down to like 684, which was the low of day today. So that's not the greatest sign to see. We are starting to see, clearly more selling pressure, but even this isn't something that should be that surprising, because February is one of the few months that is negative on average. Going all the way back to 1950, February has negative returns since 1950 over the past 20 years and over the past 10 years. It technically does have positive returns in midterm years like we're in now, but I guess it goes to show that February is one of those weird months.
It definitely is. And even though we're in a midterm year, I think that we're also seeing global tensions increasing, and we're also in a very strange point, right? Like since 1950, if we had all this craziness with Trump over the past couple years and everything, not really, besides the last time that Trump was in office, of course, but there's a lot going on out there. Each year's different, of course, but I always like going back and looking at the historical data, Mike. And something that has also been hitting the market a lot in the shorter term is these big earnings that have been releasing. Tonight, we saw AMD report, but over the next couple days, we'll also have Google and Amazon reporting on Wednesday and Thursday in after hours, respectively.
Well, we've also got another signal from the Hindenburg omen, which, as you guys might remember, can sometimes show, especially in clusters, a big problem is on the horizon. Let's start off, though, with this great data from Subu Trade over on X, and that is that the tech sector was down while the staple sector was up. And you can see the cluster of times that happened over here in the 2000s into the crash, and then, of course, just before the tariff tantrums of last year. So why does this matter? Well, the data stats are, of course, incredibly negative when it comes to the next 6 months, 9 months, and even 1 year later. And you can see here that there are quite a few bad reads that tend to happen after stuff like this. Why? Well, big money is kind of fleeing the main big tech stocks. And we've already seen this in a slowdown on the Magnificent Seven since the Federal Reserve started doing, of course, cuts back in September of last year. And if you've been watching this channel, and by the way, if you're new here, welcome, make sure to subscribe, hit that alert button. It's great to have you on board. We have been discussing this for quite a few months. We've been thinking about oil differently to a lot of other people. We've been thinking about metals and, of course, staples, utilities, healthcare, and many other sectors. So as Duality Research posted over on X just a few days ago, we see here that tech sector, while it slightly recovered during the last kind of month, realistically was one of the worst sectors out there. Energy, materials, staples, industrials, they were the ones that were going. And we actually saw a broadening of the market, which on the surface you might say is a good thing, and it is for now, but it actually does usually start to make us think that we're in what we call late cycle, where financials in particular start to come under pressure, and what was once good, which was of course growth stocks, starts to look a bit flaky. So have the earnings caught up to this problem? And also, should we still be paying attention to earnings more than anything else in 26? Well, Liz Ann Sunders here has the latest data when it comes to weekly ETF flows. And you guys can see here that people have continued to buy large cap US stocks. But at the same time, it's likely this is a lot of retail investment. And actually, global investment has been where the money's been moving, especially over the last 6 months. And we've seen that into the Asian stock markets, obviously into emerging markets throughout South America, and so many places specifically where we saw kind of cheaper indices and maybe even commodities-based stocks. And this really shows up when we take a look here at how the biggest Magnificent Seven stocks have actually been trading. We now have, of course, some from earnings, more to come this week. We still have, of course, Amazon, Alphabet, and some very important results there. But so far, Microsoft has been absolutely getting flawed. And you can see here that it is really declining this year, along with some pretty big moves as well when it comes to Nvidia starting to drop a little bit, Tesla starting to get shaky, and Meta, while it recovered, possibly starting to give up some of its gap fill style moves. This coupled with things such as defensive stocks starting to get picked up, and also this data point that we brought in our previous video, which is falling US truck sales, which could point to a weakness in the economy. Yes, there are some reasons why it could have also happened for other things, which we discussed in our last video, but these are the types of signals that you often get when there is a dull late bull market cycle. And effectively with the new Fed chair as well, while we probably expect to continue to get liquidity maybe for 26 into the midterm elections, what might happen after that could be very different. And on top of all of this, if we do get what his plan is, which tends to really rely more on getting rid of liquidity, tightening a little bit, and then if something catastrophic happens, then, of course, realistically letting the floodgates out. Remember, he was a big proponent of the global financial crisis overall package that, of course, the Fed did to help secure, of course, the crash. But he's kind of like, we fix the problem after it's happened, more so than what Jerome Powell's been doing, which is slowly providing liquidity all the way through to help stave off any problems. Yeah, which one do you like more? Be interested to know your comments down below. But in general, these are signals that things are starting to weaken. And they're not the traditional signals that you'll see on most channels and most people talking about. These are the ones that I do tend to believe still have some edge in these markets. Speaking of edge, quarterly EPS estimates do continue to do some pretty good stuff. You can see here that the overall earnings has been pretty stellar. And we've seen that with effectively stocks that have performed well and have beaten have actually gone up, and ones with poor guidance or have missed, as you'll see with PayPal in a moment, they've gotten destroyed. They have actually fallen through the floor, and the market is very, very, I guess you would say, on tenterhooks in some ways to these earnings. If we do see some of the Magnificent Seven, let's say in the next earnings, not living up to expectations, you can see they might be Microsoft-esque style sells across the Magnificent Seven. And as you know, if you've been watching for a long time, the concentration in these markets, because it's mostly tech, 37% is made up on the S&P of top 10 stocks, then all of a sudden you could be actually declining quite a lot. So things get pretty nasty fairly quickly if that occurs. Now, with the S&P actually going up and the Nasdaq not really doing anything, you might say, well, does this mean that we've completely lost everything? Not usually. At least at the beginning, there does tend to be a decent rotation, and this, of course, provides opportunity. And what tends to happen is you see the leadership turn into weakness. And of course, IGV, which is software, has been dropping consistently now for quite some time. I thought I'd include this stat just so you guys can see IGV 6 consecutive days down here from the market stats. And you can see there's some decent turn stats. But as we always say, look for the bid more than anything else. Now let's move over to App Economy Insights and their updates for the latest earnings. Palantir, of course, was a very solid earnings. They're doing very well during the last kind of 12 months. And you can see here the gains are pretty much just absolutely stellar. It's unbelievable results from them. But what wasn't so unbelievable was PayPal's results. You can see here, not too good across the board, and the stock went down around 20%. We also saw AMD come through, and yes, they had pretty good revenue, and it was actually a little bit of a beat. But overall, you can see the stock did not react well. It was down about 6% last time I checked in after-hours trade. So basically, it was a sell day across most semiconductors and most tech, and AMD felt some of that pain as well. There are still more coming. Alphabet after the Wednesday close, ARM as well, Qualcomm, Snap, Amazon, plenty of stuff here. And I think what the focus might be on is what is happening to the American consumer. And you're going to see that in the code XLY versus XLP, which we often talk about here on the channel, which is a good read of around a third of the US economy on the charts. And it's not really our opinion, it's whether there is actually a weakness starting to appear. And I can tell you that actually broke down and below over the last 24 hours. So this is a fairly big day for that indicator indeed. Everything else here are the options moves from Earnings Watcher. And you guys know that, the big thing there with earnings is that usually earnings provide opportunities, but actually because the market's been so volatile, especially in metals, and then of course also in other sectors that started rolling, it's been pretty good actually not even to bother with the earnings too much and actually focus on the other sectors, which have been running pretty well. I mean, energy's done pretty well recently as well, and that came out of course, nowhere for a lot of people, but we've been seeing it here in flows. Speaking of strange flows, we did get a number one dark pool that just came through here from ARKX, and this is courtesy of Volume Leaders, and you can see here it's a monster trade, pushed ARKX up. And obviously, this is the space exploration and innovation. So we all know why. Of course, this year is going to be probably some IPOing of SpaceX, etc. And we're getting a lot of people very, very, I guess you would say, confident and feeling good about that type of sector. I would always say that sector is probably more of a trade than anything else. But hey, you guys often like to look at the space. Remember Virgin Galactic? That one was interesting, though. GLD, what happened here? A couple of large trades. Obviously, gold has since recovered to this point. So just remember, if it keeps going up, these were likely buys, and I do think that nothing much has changed. Even though we've got a new Fed chair announcement, in general, we have to kind of look at it as we're still in a currency war in terms of how the world is going, and a lot of the things that are already still around are probably going to continue being around. So